is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Not so pumped, the U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot? What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg an early end to tightening is wishful thinking. So, first thing is first, let's check in on the markets. We've been bouncing up and down a little bit. I mean, not down, but certainly we opened about 1% higher, and you can see now European stocks gaining some 0.4%. This is all about perception. Do you think that if OPEC cuts a lot and inflation goes up, does it make the central banks more aggressive in hikes? Or on the contrary, do you think that it really hurts, tipping the world into a recession? And so are they a little bit more accommodative? If you're on a trading floor right now, this is the thinking that you need to decide on, and that will change your view on some of these equities. S&P futures, you can see now largely unchanged, but on the lower side, a lot of focus because we have 3 surveys here in the UK on whether the UK is still investable. For the moment, that stock price of FTSE 100 is actually unchanged. We also worry about mortgages, now at a 6% high. Let's remember, this is the highest since 2007. The DAX gaining 0.6%, similar to the CAC 40, 0.3% higher. Now, Saudi Arabia's energy minister, Prince Abdulaziz bin Salman, says U.S.-led plans for a price cap on Russian exports are fanning the uncertainty that drove OPEC Plus to its biggest production cut in 2 years. Now, the minister refuted claims that Riyadh is siding with Moscow over the West.
I would say an insulting view to assume that OPEC Plus is nothing but Saudi Arabia and Russia degrading, and too unfair, because from day one, as I took office, I was saying, as a chair of OPEC Plus, I will treat every member of OPEC Plus as equal as any of us, simply because we need the consensus.
Let's head to Vienna, where Bloomberg's Manus Krein is standing by, our news-breaking machine. So, Manus, what's the latest? You had 2 very important interviews, Saudi Arabia and Russia. What did you learn?
There's going to be a vast amount of uncertainty on the implications on the price caps from the Russian side and from the Saudi side. This is what they are perhaps most fundamentally worried about or concerned about. I would just emphasize that I did try to press His Royal Highness Prince Abdulaziz bin Salman on the response in the bunker last night from Jake Sullivan in terms of an SPR release, in terms of potentially NOPEC coming to life again. He would not be drawn on those issues, Francine. We're not here to deliberately jack up prices. We're not going for a jumbo set of cuts. And indeed, he did warn. Yes, you could say they are seeing a 10% rally in prices. That's going to fuel inflation. But as he said back to me on the inflation side, he said central banks, this vehement commitment by central banks to tame inflation regardless of the impact on growth. Those are the jumbo issues, as it were, that we talked about. But when it comes to price cap, the critical red headline went to Novak. He stole the show in the prints on the headlines. It was about price caps and the impact on production in the near term for Russia. Let's listen in.
Indeed, there have been 2 important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
let's look towards February 2023. You will have more sanctions, we assume. You will potentially have a price cap. Can you tell me with a surety what your production in February 2023 will be? You say 93% for 2023, but is that the worst case scenario by February with more sanctions and a price cap?
Such actions, as we're seeing, creates, i.e. the price cap, creates a very bad precedent, and will primarily hit the ones who are actually doing it and the ones who are implementing it. We know, and history has a countless number of examples of when market interference, especially with the mechanism of price controls, can only lead to a deficit of a certain good. This mechanism is unacceptable to Russia, and if it is implemented, we are not going to supply countries which join this mechanism.
Deputy Prime Minister of Russia on his first trip to the heart of Europe, sanctioned by America, access by Europe to talk oil and endure the relationship with OPEC and OPEC+. Price caps are supposed to keep the oil flowing. It's going to reduce Russian production, and it's going to introduce volatility, according to the Saudis, Francine. So those are the messages coming through from both sides here.
Yeah, great interviews. Manus Krani on the ground for us there in Vienna. Thank you so much. Now, we're also joined by Carnel Tombur, Co-Chief Investment Officer for Sustainability at Bridgewater Associates. Karen, thank you for joining us. I mean, there's a different number of plays outside from sustainability, but of course 100% linked to this. What do you see as the main market schisms that could get us away from more money being poured into sustainable investments?
I think that this environment has helped investors reflect on what their values are and what they're trying to do in choosing to move towards sustainability as a goal. You've had a 9-month environment where cash has been king. The tightening, the fact that real yields have been rising and central banks have needed to catch up was the single most important force in markets. So all assets did poorly. And within that environment, the one best performing asset was any kind of energy that got very squeezed. And looking ahead, you're likely to have a very tough environment for investors continuing as policymakers battle between not being able to get what they want on inflation or on growth. And I think that that's left investors in a tough spot, whether or not they prioritize sustainability goals. And those who prioritize sustainability goals, in some sense, more committed given how much the world has changed.
Karen, how has the world changed in terms of perception, but also inflation because of that massive OPEC cut?
I think that the OPEC cut is the news of the day and likely to sort of put a supply bottom, if you will, underneath what could be a lot of downward pressure on all commodity prices from the fact that now you have all these interest rate hikes in the system. And so what's happening is, you had this huge inflationary force coming into this year that was going to show itself both in nominal demand and in inflation. And that's what we got, some of the highest nominal growth we've seen. Now that there's been as many interest rate hikes as we've seen, there is a lot in the system to slow the economy, and that's going to take some time, but it's going to slow the economy. It's going to slow demand. And from the perspective of any price, certainly oil, you have to get some decline demand showing up in lower prices unless supply gets cut. I still think that the decline in the economy that's coming is more severe than expected, and that the supply decline helps put some bottom against that.
But Karen, why do you think markets are still, pricing in this Goldilocks scenario, or are they too optimistic about their own future?
Absolutely. I think markets are pricing in this Goldilocks where somehow magically both we don't have a very severe recession and earnings don't get hurt very much, and inflation sort of magically comes down to where central banks want it to be. I think the reasons markets are doing that is because it's what we've gotten used to. We've had many decades where central banks were able to get what they want. They weren't very constrained. There were so many secular deflationary forces that pretty much every time the economy slowed a little, central bankers could ease massively into that situation, not risk inflation, and inflation would never get out of their control. But the secular environment has changed very significantly. There are big secular inflationary pressures coming into the environment. And I think it's going to take some number of years for markets to adjust to that and realize just how constrained policymakers are and how they're not going to be able to get both the economy and unemployment outcome they want and inflation outcome they want at the same time, which basically necessitates lower equity prices.
So, Karen, if you look at all of these challenges, because of the proximity to Russia, and I guess, you know, the buffer that Europe doesn't have, is it going to be the region that will really underperform the rest of the world?
Yes, I think Europe and the UK have already borne the brunt of this environment because they're the regions that are also having a more secular competitiveness shock. That's a much deeper shock than it's kind of the one-off of COVID, if you will. These are economies that are reliant on having access to at least competitive energy prices relative to the rest of the world to have a manufacturing sector. And that shock, the inability to get energy at the same prices the rest of the world is going to be, and the need to actually ration them, actually experiencing stagflation. It isn't just rising inflation and rising demand, but you actually have to ration energy away from households, away from businesses. That's going to be a very long, much deeper, more challenging shock than to the rest of the world, because beyond getting the immediate, acute phase right now of getting through the winter, there's this long-term competitiveness issue that's going to come. And you see it already with the central banks dealing with much tougher circumstances, wanting to protect households, but already running into what feels like a balance of payments crisis. And those conditions where they realize that, they're going to get currency weakness and balance of payments pressures if they try to print money into rising inflation, and yet they also want to protect their economies.
Yeah, and we have a great chart, Karen. We'll get back to that our Valerie Teitel put together looking at break-evens versus WTI. Karen Carnel Tombur from Bridgewater Associates stays with us. Coming up, more Fed speakers pour cold water on hopes of an early dovish pivot. We continue the markets conversation next. This is Bloomberg.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
I'd like to reach a point where policy is moderately restrictive, somewhere between 4 and 4.5% by the end of this year, and then hold at that level and see how the economy and prices react.
FOMC members Mary Daly and Raphael Bostic saying that the Fed is unlikely to cut rates next year. Now that's as traders bet on at least one reduction in 2023. Now Karen Carnel Tombur from Bridgewater Associates is still with us. Karen, first of all, there is a belief in the markets that, again, going back to that Goldilocks scenario, that they can have it both ways. But I feel like Fed officials have just been saying the same thing, which is we will stop at nothing to keep inflation under control. So if that's the case, if that's your interpretation, where should Treasuries and equities be?
Well, I think that an important thing to keep in mind is that the Fed's job today is actually not that hard yet. I think it's only going to get harder because right now they're in a situation where the economy still looks pretty great. So they can say, we're going to prioritize inflation, 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 because they haven't actually seen any real economic slowing. I think what's going to happen in the next few months is going to get a lot tougher because the economy will slow. They've hiked enough. There are enough hikes in the system. And we know from past cycles that there is a lead lag. There's time from the rates rising till you actually get the slowing making its way through the system. So they're going to start seeing, better inflation numbers, worse economic numbers, but be in this spot that's going to feel terrible because they're not going to want to slow the economy further. But while inflation will slow, it's not going to get to the numbers that they're hoping for. So I think it'll be a much tougher call for them in a few months. Right now, my guess is they're going to stay roughly like what's priced in. They're not going to want to kind of upset the apple cart. They're going to try to do roughly what's priced in. Once the economy starts slowing, they'll have a tougher call. And my guess is they're going to need to start having aggressive hikes again in order to make sure that inflation actually gets under control and suffer a lot more economic pain than they're hoping to.
Karen, what's your take on China? Could it be that actually it's much worse than expected, and that would also justify the OPEC cut?
I think that China is is worse than expected in the sense that, look, China is the most disconnected economy. It definitely has its own cycle. It's easing and tightening at its own pace. It already has had a pretty deep recession, and it's trying to stimulate relative to that. But its stimulation has not been super effective, and they haven't kind of pulled out all the stops, if you will, because while they're not constrained by inflation, they're the one economy in the world that doesn't have a major inflation problem, they do feel constrained by a lot of other issues. They really want to change the quality of growth. They want to make sure that the property sector actually delevers. They want to make sure that, basically new debts don't get created as a way of responding to the slowdown. And so they're in a situation where they're not really turning their economy around in a huge way. They're not going to be in a deep recession, but they're not going to be the global engine of growth that can offset how weak the rest of the world is going to be. Yeah. And that means that, especially from a commodity perspective, oil less so than other commodities, but they're a major, major source of demand. Yeah. And if property sector is the thing they need to slow, that's where a lot of commodities go.
Karen, thank you so much for the terrific briefing. Karen Carnel Tombur, their co-chief investment officer for sustainability at Bridgewater Associates. Now, coming up, demand slowdown, hiring freezes, and the end of easy money. Tech has had a rough ride this year. We'll gauge the outlook at the Investor All-Star Summit next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to Tom McKenzie, who's at the All-Star Investor Summit at Hotel Café Royal in London with a guest. Tom, over to you.
Francine, yes, this is a perfect environment to talk about what is happening within the tech sector at a time, of course, of higher rates and valuations coming down. European tech companies have raised about $56 million this year. So it's not all bad news, but of course it is a more challenging environment. And what better person to speak to about this than a partner from one of the leading VC firms across the continent, MMC Venture Partners. And one of the partners, Meena Saman, who joins us this morning. Meena, thank you for coming onto the show. Let's start then with this environment that tech is facing. Higher interest rates, lower growth, and a lot of pressure to cut costs. Is tech being brought back to earth at this point?
First of all, thanks for having me, Tom. I think we're at a quite interesting space within the ecosystem. We came off 2021, which was incredibly high. I think 2022, we're back to more rational investing at the early stage. Yes, companies do have to look at their cost base, and some might say it's a tough time to be a founder, and I'd probably agree with that because you're having to look at your own operations and your runway and when you might next raise capital. So we are seeing across the board some level of cost cutting, but where there's great companies, they will still continue to invest in growth.
I mean, it does bring to mind that famous Warren Buffett quote, when the tide goes out, you see who's been swimming naked. Are you seeing a tick up in failures?
I think there will be. Don't forget, a lot of companies raised a lot of capital last year. So there will be many that do ride the storm, but it's a matter of which companies become the acquirers versus which ones are the ones that get acquired ultimately.
Have valuations troughed?
We've seen them come down. So we invest at the very early stage, so at the Series A. And obviously public markets have come down and that has trickled down. And so at the start of the year, there was a big mismatch between investors and founders just from a valuation expectation. But now we're seeing that come back together for sure.
Some of your kind of most high-profile investments include the delivery service Gusto, but also Copper.co, which provides services to institutional investors within the crypto space. Let's start there. Given the ruptures within crypto, Bitcoin's trading at what, $19,000. What is the case still for a company like Copper.co in the months and years ahead?
I think you have to think of Copper as not directly impacted so much by crypto, but selling infrastructure. And so enabling big institutions like a BlackRock or a State Street or whoever it might be to have access to those cryptocurrencies. And we're still at a place now where we're seeing adoption through those large institutions. And today is a time where investing in that infrastructure for when the crypto markets do come back, for them to really have a product and products to sell.
What are the investments you're most excited about in the 12 to 24 months ahead?
I think there are a few really interesting areas that we look at, and we're thematic research-driven investors. One of the areas that we're looking at today is what we call data infrastructure software impacting healthcare, financial services, and security. And over the last 5 years, we invested a lot in AI, where data was available, and so you can automate a process or apply AI to do analytics. And over the next decade, we think the value is going to accrue at the infrastructure layer, where new softwares are going to be created to accelerate AI or create new data sets to impact those industries.
Okay, data infrastructure. That is a call there from Mina Saman, a partner at MMC Ventures. Thank you very much for joining us on the views around valuations that we're seeing becoming a little bit more rational within the tech space. Yes, it is a more challenging environment given the run-up in rates that we've seen. And we are starting to see, and Mina is highlighting this, cost-cutting across not just his portfolio companies, but companies across the tech space, as, of course, companies look to become more lean in an environment of slower growth. This is the Europe All-Star Company event. It happens once a year here in London, and it really does focus on some of the innovation, creation and technology that is driving some of these companies going forward. So it's an exciting time despite all of those challenges. We're going to have plenty more through the hours ahead. Do stay with us. This is Bloomberg.
Not so pumped. The U.S. slams OPEC Plus for its decision to slash crude output, saying the cartel is aligning with Moscow. Rallying cry, Ursula von der Leyen calls for EU intervention in gas markets. Regional leaders meet in Prague to seek common ground. Plus, pivot. What pivot? Fed officials pour more cold water on equity bulls. Mary Daly tells Bloomberg that an early end to tightening is wishful thinking. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, £300 billion has been wiped from UK stocks and bonds over Liz Truss's first month as Prime Minister. It follows a market rout over her government's sweeping tax and borrowing plans. You can see our next guest sitting to the right of the UK Chancellor. She's one of the top city bosses that the Chancellor met to try and restore market confidence. Well, I'm very pleased to welcome Tiina Lee, Chief Executive from the UK and Ireland at Deutsche Bank. Tiina, always such a pleasure to speak to you. You make me smarter on what we should be looking out for in terms of pitfalls, but also opportunities. First of all, what's your take on the UK right now? You sat next to the Chancellor. Yep. There's, obviously a credibility problem that was played on the markets. Can they get back on their feet?
I think they can. I mean, there's been a lot of sound and fury that we have seen over the last 10 days. And I think the work that the Bank of England has done in terms of announcing their gilt purchase scheme has clearly calmed markets. And we've seen that in where sterling has moved to levels where it was before the mini budget. And gilt yields have obviously stabilised, even though at much higher levels. So I think we have a pause here. The question obviously is around the medium-term financial plan. Yep. That is on November the 23rd. That will be coming obviously with the OBR assessment, which I think will be key, and that was one of the things which spooked markets because that was lacking with the mini-budget statement. So I think for me the question is, given that the Bank of England will conclude, or allegedly conclude, their purchase scheme by October the 14th, what happens between now and the 23rd? So much of that is around, I think, communication with the market. That was missing.
Which is strange because they also put the markets, or certainly the city, at the kind of the forefront of their plan.
That's right. That's right. So I think that started to happen. We saw the coordinated statements from the Chancellor and from the Bank of England early last week. The purchase scheme was helpful, and also maybe some of the statements which have been coming out of the Chancellor with regard to his commitment to fiscal discipline.
Tiina, when you look at the Bank of England and the fact that they're starting QT, I don't know whether they need to wait or whether this is something that would make a huge difference for your bank.
So QT, I think, is a programme that the Bank of England has spent quite some while preparing the markets for. So the Bank of England will still be committed to that programme. What happens, though, is more focused on the short term. In other words, do we actually see a slight adjustment to that programme? Do we see an operation twist type option where perhaps the Bank of England may buy long bonds and actually sell short gilts? But that, I think, remains to be seen. So I think QT is absolutely on the cards, and that's something which we're anticipating is going to actually play into the supply of gilts for 2023.
I think you also have some great new headquarters in London, right, in a year. How committed is Deutsche Bank to London and to the UK?
We are very committed. So I think, as you rightly say, we've got flagship headquarters, which is right now under construction and will be moving in October of next year.
And so what does that mean in terms of your role, though, for your clients? Will your role change given the uncertainty in the UK? So is it, attracting investment? Is it clients elsewhere that see opportunities because of pound, or are people pulling back right now?
No, absolutely not. I mean, we have so many clients here in the UK, and as you know, London is a great cross-border financial centre. So that was actually very much the crux of the conversations that we were having with the Chancellor and his team last week around actually how, as an industry, we can continue to support London as a leading global financial centre and continue to attract capital and talent into London. So I think that is not just about the short term, that's also through the medium term as well.
But the UK, and especially London, seems to have lost quite a lot to Amsterdam in terms of IPOs and things going through the pipeline. Do you think this government understands what is needed to get that back? I know there was also talking about, for example, ministers being able to supersede some of the regulators in attracting IPOs.
Yes. So, I mean, IPOs are really at the end of the value chain.
Yeah.
And actually the focus, and again, some of the key messages that we've delivered to the Chancellor and his team is around the need to support startups, to support seed funding, and actually make sure that those high growth companies actually stay in London, and IPOs actually fall out of that in 2, 5, 10 years' time. So for us, it's a long game. This isn't something that can either change for the positive or the negative overnight. It's really commitment to London as a financial centre that's really important.
Do you think you'd play a role also, further north or in branches elsewhere?
You mean in the UK?
Yeah, in the UK.
We already have over 1,000 people in Birmingham.
Yeah.
So that is a centre which we will continue to be investing in, and we also have operations in Ireland as well. So the UK will continue to be a significant region, really, for Deutsche Bank Group, both in terms of profitability, but also the depth of talent that we're able to source here in the UK.
I have a million questions also on, the relationship between the UK and, of course, Europe on clearinghouses and things like that. Would you move people? I know you've already moved some people, right, to continental Europe.
That's right. I mean, for Deutsche Bank, we've always been very fortunate in the sense that we have such a significant operation already, not only in Frankfurt, but in the other European hubs. So we have moved people in the low hundreds. That's working incredibly well. And we continue to monitor where it's best placed for our people to be, both in terms of sales coverage, but also in terms of risk-taking.
What's your biggest challenge right now? I mean, there's a lot happening in the UK. It's also, I guess, trying to get people still to return to the office. I imagine some of them want to work from home. As chief executive of the UK, I mean, you're juggling so much. What do you think is hardest?
So I think the hybrid working side of things, we've actually had lots of people return to the office. As you would expect, sales and trading are in 5 days a week. Yeah. Really the challenge is around our infrastructure functions, not around getting them in, but actually making sure that there are reasons for them to come into the office. And that's really important. So that's not just about me messaging that I'd love to see more people around Deutsche Bank and around our offices, but also making sure that our leaders and our managers across the whole region really make it worthwhile for our people to come in.
Do you need to pay them more because of inflationary pressures?
Not necessarily. I mean, we're very mindful to cost of living. We're mindful to what inflation looks like here in the UK. I think, as we know, we're expecting CPI to peak at something like 11% by the end of this year. And we're looking at the talent market. So there will be pockets where the market for talent is extremely hot. We seek to remain competitive. We're not looking at wholesale increases in terms of salaries, in terms of addressing the cost of living crisis, but we are very focused on being competitive.
Tiina, overall, do you think this government will be business friendly after the mayhem that we saw over the last 10 days? Do you think they'll be good for activity, they'll be good for business, they'll be good for the City of London?
So I think what we have all welcomed is the engagement actually from this government, both in terms of wanting to hear directly from industry, and I should say not just financial services, but from business more broadly. Clearly the growth agenda is a key priority for this government, and will be critical in terms of how the market assesses the medium-term fiscal plan. So it's not a question of top-down. They're very keen to hear from practitioners what we can do to help support that growth agenda.
So what would you need from them? I don't know whether there's too much red tape or, again, it's regulation that needs to be loosened up a bit to be able to rival other European capitals.
So I think there's always room for improvement when it comes to the regulatory framework. However, in my view, I think it's more about streamlining rather than sort of wholesale change and a race to the bottom. So for me, it's very much evolution rather than revolution. I mean, remember, we have some of the most sophisticated regulators here in the UK, and for me that is actually a necessary foundation for stable and financial markets.
Yeah, but some people say it's too regulated, right? It makes it more difficult because the regulation is so high compared to other places.
That's right, and I think that the government is open to actually hearing that, and I would say actually our regulators are too. So I think watch this space. It's early days, but I think there's lots of areas where the breadth of regulation and the number of regulators potentially can be streamlined.
When you speak to a lot of your clients, are they ready to put more money in the UK in terms of investments, or is it a little bit of a wait and see because of the shock of the last 10 days?
I would say that some clients are pausing. Yeah. And I think that's reasonable. As I said, we have a period of time between now and November the 23rd. We have seen we have seen sterling depreciate somewhat against the US dollar. That's now recovered to about the 112, 113 level, which is where it was before the mini budget. But obviously, I think we should be very mindful of the value of sterling because that does have an ultimate impact in terms of the value of UK PLC.
Yeah. Do you worry? I mean, one of the things that we've been looking at is mortgages, which I don't think impacts you directly.
No, that's right.
But does it impact, I guess, the viability of certain firms? Do you worry that certain customers in the UK will go bust because of what we'll live through in the next four months?
So I think, as you said, for Deutsche Bank, that's not a sort of a relevant impact. So for us, it's really second order in terms of the impact for us. We really are focused on speaking with our UK clients and really helping them navigate what are really tricky markets in a rising interest rate environment.
Tiina, thank you so much, as always, for joining us. Tiina Lee, their Chief Executive Officer for the UK and Ireland at Deutsche Bank, joining us for an exclusive conversation on the City of London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Trade Organization says global trade will slow next year as major economies face strong headwinds. The WTO is forecasting that global goods trade will now grow by 1% next year, a big revision on its previous estimate of 3.4%. It blames a cocktail of factors, including rising prices, restricted energy supplies, and growing US-China tensions. German factory orders dropped in August, hinting at a lack of momentum as Europe's biggest economy stands on the brink of a recession. Demand fell 2.4% from the previous month, though data for July was revised upwards to show a gain. This came after the late reporting of some large aerospace orders. North Korea has fired 2 suspected short-range ballistic missiles towards waters where a US aircraft carrier had been deployed, making a total of 10 launches in less than 2 weeks. That's one of its biggest test barrages under leader Kim Jong-un. The firings came shortly after Pyongyang condemned the Biden administration for escalating tensions. And King Charles is expected to be crowned on June the 3rd next year in a ceremony at Westminster Abbey. Bloomberg has learned that the British officials are converging on that date, although talks are still ongoing. The coronation comes almost 70 years after his late mother was crowned and will form the centrepiece of days of celebrations to mark the beginning of the monarch's reign. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Calls for a street party, Francine.
Always a street party. I'm always in. You organize, if I get my voice back. This is, Leanne, all the street partying that you and I have been doing. Except you keep your voice, I lose it. This is the problem. OPEC Plus, let's get back to business. OPEC Plus defies Washington, agreeing to the biggest production cut since 2020. Now, we'll bring you the very latest on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, OPEC Plus has agreed to cut its output by the most in 2 years, earning a rebuke from the White House. Meanwhile, the EU approved new sanctions on Russian oil, drawing a veiled threat from Moscow. Now, let's head to Vienna again, where Bloomberg's Manus Cranny is standing by. Manus, first of all, great interviews. So what's the latest?
Fran. Well, the latest is job done, isn't it? Mission accomplished. Markets up 6, 7, 8, 9% in the space of 4 days. Or is it? Are we about to embark on a very serious period of conflict, having Joe Biden expended a great deal of political capital on a rapprochement which might be under reconsideration? The message is very clear. We're worried about price caps. The message is doubly clear, which is for Russia, price caps could mean production reductions. But the Saudi minister, His Royal Highness Prince Abdulaziz bin Salman, we're not here to deliberately jack up prices. No, Manus, I'm not setting the stage for jumbo cuts to come. This is about moving on from a monolithic issue, which was COVID, in splendid isolation, to a whole host of uncertainties. But of course, this was the issue as to whether he likes to keep speculators ouching like hell, and whether that job was done. Let's take a listen to the Prince.
Masochist, or I said this, but I was talking about more to do with making sure that we have disciplined market, a market that serves its original purposes, which is a market that has sufficient liquidity. That liquidity has been hampered by extreme volatilities. Extreme volatility, unfortunately, bring premiums to become very expensive.
And that market is still fragile, it is still illiquid. There's a warning shot there from His Royal Highness. But of course, it's about the volatility, Francine, that could come from price caps. And that's perhaps the deeper story at play here in OPEC Plus. The known unknowns and now the unknown knowns. Francine.
Yeah, I feel like it's all falling apart. What's next for Saudi-US relations?
I think Saudi-US relations are going to be tested. This is where, you know, the adults need to stand up in the room. You've had the Biden, Jake Sullivan immediate response in the depths of the press conference. SPR, you want to cut? You want to cut by 2 million barrels a day? I will see you and raise you. I'll go for an SPR release. And you know what? If you want to get frisky with me again, I'll unleash the hounds of Congress and raise the spectre of NOPEC. That might get everybody ouching a little bit more in the building behind me. But when it comes to the Russians, they are much more focused on the price caps. But these relationships between the USA and America, his brother came and fist bumped the President of the United States of America. That's called global political capital. Francine.
Yeah, it certainly is. Manus, thank you so much. Manus Cranny there with the very latest and, of course, talking about his 2 great interviews. Now, sticking to energy, for more on this, let's also get in Maria Tadeu, who's live for us in Prague this morning, where an extraordinary summit is being held. So, Maria, the head of the Commission, Ursula von der Leyen, calling for a gas price cap. Will it actually happen?
Yes, she hasn't, Francine. Now she's put it on paper. This is a letter she sent out to all the heads of states of the EU 27 countries yesterday, in which she argues when you look at the prices in the Dutch benchmark, the TTF, it no longer reflects, according to the head of the Commission, the real cost of gas. And therefore, the European Union needs to transition away from it. And that means temporarily a cap. The problem is, and this is the fundamental issue, is that you have a growing number of countries that call for it. The Commission now responding on paper, but they can't agree on a formula. When we talk about a price cap, Francine, there's at least 5 different options on the table. And then the other issue is that Germany is still not behind this idea, and then there's the ramifications potentially. If prices do go down, then maybe demand destruction will not be as intensive as it needs to be. So then you're back to square one.
Yeah, the problem with all of that is that there's also politics in the middle. So what happens in the politics? You have 44 heads of states, and I think the UK Prime Minister is also arriving.
Yes, and Francine, she is here today. It's finally confirmed. Remember, at one point, there was questions as to whether or not she would attend this meeting as a European political community. Of course, countries that are members of the EU, but also others that don't. And the idea here is that they can sit around and debate issues they have in common. Now, for Liz Truss, she gets to step away from her domestic problems for a few hours, potentially meet with Emmanuel Macron. Remember, a few weeks ago, she was asked, is he a friend or a foe of the UK? And she said the jury's out. Maybe today they clarify issues, also issues around Brexit. And then you have the Ukrainian question, which is still the perennial debate here, especially because the Turkish president is going to be here too. And he has been key in that grain deal, which could perhaps expire going into the winter. So there's a lot of Ukraine too here.
Maria, overall, I mean, when you look at the different players, who are the heads of state that you'll be watching out more closely for?
Well, Francine, today really is Emmanuel Macron. This is his baby to some extent. He was the one that pitched this idea. And when I spoke to French diplomats yesterday, they say to some extent this is already a win for French diplomacy. The fact that we're here today in Prague and this meeting is called the European Political Community may actually help to reset some of the difficult relations like the UK, but not only. And then, of course, it's Olaf Scholz. You know, there's a lot at play with that mega package, 200 billion euros. Remember, Francine, it sparked a lot of tensions, and there is a feeling here that Germany still has some explaining to do.
Yeah, that's absolutely right. Maria, thanks so much. Maria Tadeo there in Prague for us. Now, coming up, we stay in Vienna throughout the morning to bring you the very latest on OPEC's biggest production cut in 2 years. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Elon Musk and Twitter have agreed to postpone the billionaire's long-awaited deposition in the company's lawsuit. Musk reversed course earlier this week and said he was committed to going ahead with the $44 billion takeover. The move comes as lawyers trying to finalize procedures to dispose of Twitter's lawsuit. Now, German factory orders dropped in August, hinting at a lack of momentum as Europe's biggest economy stands on the brink of a recession. Demand fell 2.4% from the previous month, though data for July was revised upwards to show a gain. This came after late reporting of some large aerospace orders. Virgin Atlantic is pulling out of Hong Kong for good. The UK airline is cancelling flights and closing its offices in the Asian financial hub, ending a 30-year history with the city. It says one key factor is closed Russian airspace, which extends flights between Heathrow and Hong Kong by at least an hour. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York, Anna Edwards in London, and this is Bloomberg.
This has been an incredibly tough year for the bulls. It's been a great year for the bears.
There's a lot of distortion in the data.
It's really about finding what's going to work in a persistent high inflation environment.
I think that there's a concern in the broader financial markets that something might happen within the U.S. markets.
It's just the uncertainty factor that's keeping markets on edge.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Traders versus the Federal Reserve. They keep betting that the central bank will cut rates next year, even though Fed policymakers keep saying that they won't. The OPEC plus oil production cuts. The Saudis snubbing President Biden and helping Putin. And European leaders meet in Prague. The summit will be dominated by the energy crisis and the war in Ukraine. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, the European market's kind of catching up with the US of yesterday today. The global vibe, though, seems to be trying to work out what the significance is of those production cuts from OPEC, what that does to inflation and to global growth.
Yeah, and we're going to have more on those stories in just a minute. And of course, by extension of wondering what it means for inflation, there is a question of what it means for central bank policy, as we've had the pivot conversation revival in recent days. And of course, that is something they also pay attention to in Asian markets, where it really was a mixed picture for equities overall. You did have the MSCI Asia Pacific Index as a whole up about 0.3%, in part due to gains in markets like Japan. But you had some underperformance as well coming from Hong Kong, which saw some of the gains of yesterday, the best day for 6 months in the Tuesday session, retreating a little bit, with the Hang Seng down about 0.4%. Now, as I raised the central bank question, of course, you've had Fed speakers pushing back on the idea of a pivot, pushing back on the idea of rate cuts coming in 2023, and that has put some more upward pressure on bond yields. In Australia, for example, overnight, the 10-year yield rising 14 basis points to the 377 level. One interesting thing I wanted to point out in foreign exchange as well, the South Korean won stronger against the dollar for a fifth day in a row. That is its best 5 days against the dollar going back to the spring of 2020, strengthening by about 0.6% this morning, trading right around the 1400 level, Matt.
All right, we are looking at S&P futures that are down this morning after a down day yesterday. Although it should be mentioned, we were off a lot more, and Wells Fargo has come out and said they believe that one options trade yesterday provided a big bounce in the market because market makers had to reposition themselves by going out and buying the underlying equities. So really interesting trade. Great story in the Bloomberg. Recommend you check it out. Nonetheless, looks like we're headed back down again today. Only 0.4%, not looking at the 1% plus drops in futures that we saw yesterday at this time. We do see the Bloomberg Dollar Index starting to climb a little bit, though. And if you looked at the chart, the one-day chart of this, you would see that it had come down and is now going much further back up. So the gain of only 0.1% in the dollar index doesn't look terribly significant until you back out and see from where we've come, or from whence, maybe? I got to ask Anna about that. The 10-year yield right now barely changed, but at 375, so still at a relatively high level. And again, this is a case of a yield that was down and has come back up through the unchanged level into, well, for a moment, into positive territory. Nonetheless, the point is it's come up from a lower level. And NYMEX crude as well, 87.82, after the big cuts that we got yesterday from OPEC and all the surrounding stories about how OPEC may be siding now with China and Russia. We saw some gains in this market, although they're not quite so pronounced. You see 2 million barrels a day, Anna, and you think we're going to see a huge jump. We have seen forecasts, though, for bigger gains, in Brent especially, right? Goldman Sachs says 110 a barrel now by year end.
Yeah, absolutely. From whence we came, I don't know, sounds maybe right, Matt, but even here in ye olde England, that sounds a little old-fashioned, so maybe not. Let's have a look at European markets. We've got European stocks giving us a pretty kind of mixed picture right now, fairly flat, either side of the flat line, down 0.25%, and that is, again, an oil story, down by 0.25% there. The CAC 40 fairly flat, the DAX up 0.1%. Let's have a look at where we are on some of the fixed income stories and energy stories across Europe, because these are having an impact. There's a big focus, once again, on the long end of the UK gilt curve. Yes, we know the Bank of England is operating here. Yes, we know that they're doing quantitative easing. Essentially, they're buying some of the bonds in the market there to stabilise the market still. They haven't been doing that so actively over the last couple of days. But a lot of people are asking, what happens when we get to the end of the cliff edge? We've seen mortgage rates rising in the UK, and that's adding to concerns about how this spreads into the underlying economy. Conversations going on about that. The Italian 2-year yield in focus as well. We had seen this yield rising. We've seen the 10-year yield rising up till pretty recently. And a lot of this to do with concerns about where BTP yields go if we start to see the new government in Italy trying to take fiscal action to support the economy there. One of the ratings agencies out with a warning to watch that and watch those developments. Brent crude, Matt's already talked about where we are on oil, only up by 0.2%, to Matt's point about how we haven't seen outsized reaction perhaps to those cuts in production. Are they really going to be as much as billed? And have we seen a big run-up in prices in the expectation of these cuts? Both of those could be true. But as Matt says, 110 is the call now for some. We've seen Goldman Sachs, Morgan Stanley and UBS all talking about going north of 100. And Shell, despite the fact that we have a broadly supportive environment for oil prices, then Shell is losing ground today, down by 4.4%. They put out a trading update, Kailey, and some analysts talking about that being a little bit weak in terms of their performance.
All right, Anna, well, let's get back to the central bank story because Fed officials keep repeating the mantra that they don't plan to cut interest rates next year. San Francisco Fed President Mary Daly and Atlanta Fed President Raphael Bostic were the latest to bang the drum on the need to keep tightening in place to reduce inflation. Mary Daly spoke to Bloomberg's Michael McKee in an interview yesterday.
I don't see that happening at all. I see us as raising to a level that we believe is restrictive enough to bring inflation down, and then holding it there until we see inflation truly get close to 2% and demonstrate that price stability is restored.
Bloomberg's Danny Berger joins us now for more. So, Danny, their message is clear. The question is the market receiving it?
No, not really, to put it just flatly, Kailey, because we are still pricing in cuts for next year. So for our radio listening audience, I have the euro-dollar curves up on a chart in front of me. I'm looking at next year's, what's implied for rate cuts and for 2024. So at the moment, we're implying one rate cut in 2023 of 25 basis points and at least two in 2024. Again, this is not what the Fed is saying. Both Daly there and Bostic yesterday saying we're going to hike rates, and then once we get there, we're staying at this restrictive level to make sure that we have conquered inflation. So that's potentially why we will see more jittery markets against things like tomorrow's payrolls report, because we're looking out for any of those clues if there are cracks that would allow them potentially to cut next year. But for the time being, no, the markets are not listening to the Fed saying that they will keep rates restrictive.
Danny, I also saw a great story on the Bloomberg last night pointing out that world currency reserves are shrinking to the tune of about $1 trillion or about 8%. That's a big drop.
Not only is it a big drop, Matt, but for that level of it happening in the first half of the year, that's the most that we've ever seen since the Bloomberg data, which goes back to 2003. At heart of the issue here is the fact that the dollar is rising. So all of a sudden things like euro, yen, all those other reserve currencies, they've become less valuable. Then at the same time, you have treasuries selling off. So if these foreign reserves are in the form of treasuries, that's all of a sudden less valuable. And these countries are spending on energy. So it just means that the firepower they have in their tank to spend to defend their currencies is significantly lower because they're not going to get the same amount back, for example, if they were to sell off treasuries or U.S. denominated assets right now. And so at the moment, a lot of these countries still have enough FX reserves to continue to defend their currency. But the thing is, the Fed, as we were just saying, isn't going to pivot. So this could potentially just continue to deteriorate and continue to deteriorate the firepower of countries to defend currencies.
Yeah, and absolutely. And Danny, we've talked a lot about, of course, the Japanese doing this, but India, the Czech Republic, others also spending big on that front. Danny, thanks very much. Bloomberg's Danny Berger with the latest on those market themes. Let's turn to one of the important drivers today, and that is oil policy. OPEC Plus agreed to make a large production cut to keep oil prices high, drawing an immediate rebuke from the United States. The move was defended by ministers from the producers group as necessary to protect the oil industry and their own economies from the risk of a global slowdown. Bloomberg's Manus Krani joins us now from Vienna. Manus, what did you walk away with from the last 24 hours? What stands out to you?
Look, I think it's a confluence of C's. It's the cuts which are sizable, but how real are they? The cuts, the caps, the price caps that are coming, the capital, the political capital which has been expended by the White House, and in some ways perhaps rebuked by not just Saudi alone, but by the OPEC Plus, by the arrival of Alexander Novak here in the heart of Europe, the Deputy Prime Minister. But they're not deliberately trying to jack up the price of oil. Both sides, the Russians and the Saudis, exclusively speaking to Bloomberg, talking about their concerns about the price caps. You know, price caps are supposed to keep the oil flowing through the system, but the risk to Russian production is very clear. That's going to drop. Who's going to fill that void? But of course, it is the lack of precision detail that's going to deliver more volatility on a growth shock as well in the next couple of months. Let's listen in to His Royal Highness Prince Abdulaziz bin Salman on his take on caps.
Lack of details and lack of clarity, and the lack of the fact that we still have 2 months to go for that these two things to be activated. These 2 months would be a period of uncertainty. We don't see what will be the reaction of the market, of the participant.
His Royal Highness also wanted to be preemptive, Anna, and went on. We talked about inflation and the dollar, and this is going to stoke inflation. This is going to refuel inflation. And he said to me, he said, Manus, he said, there's a vehement commitment by these central banks to tame inflation at any cost to growth. And that's perhaps part of the narrative about why, potentially why, they're taking this preemptive action in terms of cuts, or else there's some pretty awful data that they've seen that we haven't quite worked out.
All right, well, Manus, you hinted at the conversation you had with Russian Deputy Prime Minister Novak, as you said, in Europe days after being sanctioned. What were the highlights from your discussions with him?
A couple of big takeaways, Kelly, good to be with you, which is they're not really talking about potentially cutting off the gas through Ukraine. That's in the depths of the interview. Go and listen to it. Wouldn't exactly respond, but it certainly doesn't sound as if cutting off the gas route through Ukraine is really on the table. That's point one. The second and perhaps more important point is, are you at an energy war with the EU? He said, no, it's not an energy war, it's a special situation. So again, go back and listen to that. It's about reframing the narrative. He's sanctioned by your country, by the United States, but he is not sanctioned by the Europeans, and he is flowing in here. I think in the weeds of all of this, I want you to take away one thing. The OPEC Plus agreement has been extended. There is no sign of fracture between the OPEC family and the Plus family, which is Russia. And that is causing the air of the White House. And I'll tell you what, the hounds have been unleashed. More SPR, more oil from America, counter your cut. And I tell you what, His Royal Highness likes to keep the markets and the speculators ouching like hell. Well, I'll tell you what, if NOPEC comes to life in Congress, it could keep a few people here and in the hotter climates as well of the GCC, ouching like hell.
Manus, thanks very much. Bloomberg's Manus Craney there reporting from Vienna. We're going to have more on his oil interviews later on in the hour. Right now, I want to talk about the leaders, another energy story, really, the leaders of 44 countries descending on Prague for an extraordinary summit being held in the shadows of Russia's war in Ukraine. For European leaders, the focus is firmly on energy. This comes after Ursula von der Leyen, European Commission President, proposed a gas price cap. She spoke to the European Parliament yesterday.
Such a cap on gas prices must be designed properly to ensure security of supply, and it is a temporary solution to cater for the fact that the TTF, that is our main price benchmark, is no longer representative for our market. Introducing a cap on gas overall is a temporary solution until we will have a new EU price index developed that ensures a better functioning of the market.
Bloomberg's Maria Tadeo joining us now in Prague. Maria, the head of the Commission, von der Leyen calling for a price cap. Is it actually going to happen?
Well, she has, and Matt, she's now put it in paper. This is a letter that she sent yesterday to the EU 27 heads of states, in which she says, when you look at the Dutch benchmark, the TTF, it no longer reflects the real cost of gas. We have to move away, but in the meantime, there'll be a cap. The issue here, and this is fundamentally the problem, she has a growing number of countries in the EU that call for it. The Commission has to respond, but when you look at a cap, the problem is there's about 5 different versions of it. It's not clear what the formula would look like. And then on top of that, you have the political tensions that come with this. When you look at countries like Germany, they say they worry about the supply and the impact that this would have. And then, of course, the ramifications that could come with lower costs. The idea is that to get ahead in the winter, you need storage, you need supply, but you also need demand destruction. If prices go down, then maybe people will turn on the heat. And so you can see that this is incredibly complicated and very complex, as it often is when you look at a continent that essentially has 27 different systems.
Maria, thank you very much. Maria Tadeo with the latest from Prague. Kailey?
All right, Anna, well, let's take a look at some of the stocks moving in pre-market trading here in the U.S. as well, and keep an eye on some of those company stories. Of course, the one that has caught all of our attention this week is Twitter and Elon Musk. We are still awaiting further progress on that deal after Elon Musk said he wants to go through with that $44 billion buy. The question is, will the financing line up? What happens with the lawsuit? There is still a lot unanswered. And as a result, you still have Twitter shares trading below that $54.20 offer price. Right now, Twitter trading at $50.86 this morning, down about 0.9%. And Tesla, for its part, down about 0.8% in early hours. There is also a question of whether Elon Musk has to sell some of his stake in the EV maker in order to fund that deal. One stock moving higher, though, is Pinterest. Goldman Sachs upgrading the stock overnight to the equivalent of a buy rating, putting a $31 price target on the stock. That would imply more than 20% upside from where it closed yesterday, 26% upside, I believe. It's higher by 5% in pre-market trading this morning, right now trading at $25.90, Anna.
Okay, we'll keep an eye on Pinterest. Coming up on the program then, Kailey, we will talk to Matt Maley, Chief Market Strategist at Miller Tabak. We'll get his perspective on the pivot, no pivot, what's the latest thinking there, and a $100 billion bust. Self-driving cars were supposed to be the future, but detractors are getting louder as the losses are getting bigger. Read more in today's Big Take on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. I'm looking at a chart here for those of you listening on radio that shows the estimate for GDP going into next year. Clearly, it's down as markets are expecting a recession, as well as the estimate for core PCE, which the Fed really focuses on. That continues to rise. So the question is, why do we see expectations of, reportedly, a Fed pivot driving markets up, as we did on Monday and Tuesday? Is it that the market expects a recession and the Fed to turn around in the face of that? Or is it that the market expects inflation to come down, which doesn't look like the case from this chart? Let's bring in, is Simon White with us? Simon White is with us right now. Simon, you wrote a fascinating piece for the Daybreak newsletter, which is why I wanted to have you on this morning. I thought that the market maybe expected inflation to come down, which is why they think the Fed will cut, because the Fed has been really vehement that it is going to only lower rates when inflation gets back to 2%, not because the economy falls into a recession.
So, yeah, it's very curious. The bear market we're in today is, one of the 20% worst bear markets since 1929. So the equity market's kind of saying a recession is coming. But the curious thing really is that you'd expect lower prices would increase the probability of lower prices still. But if you look at option markets, what's actually happening is that the sort of demand for crash insurance is relatively declining. So the market's kind of saying, yeah, lower prices, we might have a recession, but also it's basically saying that the Fed put is getting closer. So therefore, there's no as neat demand for this sort of crash insurance.
Okay,
as there
so
was
reduced
before.
need to go out buy that insurance, even though you see downside not as much as before, or at least you think the Fed has got your back.
Yeah.
Essentially, I thought we'd been all retrained away from the Fed put, Simon. I thought we weren't supposed to expect that anymore. The Fed is laser focused on inflation, and so the equity market can just keep selling off regardless.
It's been conditioned, I think. I mean, as much as the Fed has gone out of its way to say this is different right this time, the equity market is basically saying, we don't believe you. When push comes to shove, the market's down, 25% at the max off the highs. That is bad, but I mean, it could get a lot worse. They're saying it's probably not going to, so they're not paying up for that insurance.
Okay, Simon, thanks very much. Thanks for bringing us the story. You can read that on the Bloomberg terminal by strategist Simon White. And for more on Simon's story and others, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Traders versus the Federal Reserve. They keep betting that the central bank will cut rates next year, even though Fed policymakers keep saying that they won't. The OPEC Plus oil production cuts. The Saudis are snubbing Biden and helping Putin. And European leaders meet in Prague. The summit will be dominated by the energy crisis and the war in Ukraine. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European equity markets have been just catching up really with the moves higher on US markets yesterday. And broadly speaking, globally, investors trying to come to terms with what it means for OPEC to have cut production, what that means for inflation and for growth.
Yeah, for sure. And higher oil prices are maybe bad for equities. We did have a big move lower in yesterday's cash trade, but then a jump higher. As I mentioned earlier, Wells Fargo thinks that was fueled by one big options trade, a $31 million options trade. I think is a really fascinating theory. Check it out. There's a story on the Bloomberg terminal. We have what looks like not a lot of moves. Now, it's days like this where I'm kind of wishing for Dan Curtis's, 4-panel GIP screen, because then you could see that we have a lot of drops and jumps, just like yesterday's equity market. The S&P futures are down, but only 0.4%. So maybe we didn't just see the options trade. Maybe it was the jobs number that also helped the moves yesterday, because otherwise this number should be a lot lower. We do see the Bloomberg Dollar Index right now just above unchanged, but it had also been lower earlier. And I believe the dollar is still up against the pound and the euro. The 10-year yield was down earlier. It's back up now, a little over 1 basis point, but to 376.5 at a relatively high level. And this is a problem for equities as well as the oil price, which is at $88.09 a barrel. This is for Texas Intermediate. Of course, Brent is up above 93, and we've seen forecasts from Goldman Sachs, for example, for Brent now to rise to 110 with those production cuts, which is, of course, a problem for manufacturers and anyone who uses energy like me and my truck. Kaylee, what do you see in the pre-market movers?
It always comes down to you and your cars, Matt. We know you better than that. Now, speaking of cars, Tesla is one stock to watch in pre-market movers, specifically as it relates to Twitter, because there is a lot of questions about that $44 billion deal from Elon Musk to buy Twitter that he wants to go ahead with. Will it go through? We still don't actually know for sure. As a result, Twitter is still trading below that $54.20 offer price right now at $50.79, down just about 1% in pre-market trading, while Tesla, coming back to the cars for you, Matt, down about 0.9%. But really, that is kind of in keeping with what we're seeing more broadly in large cap technology, and that is that they are mostly in the red in the early session here in the U.S. NVIDIA is down by about 1.1%, and Apple down by 0.5% as well, Anna.
Kailey, European equity markets then making up for lost ground when it comes to the US session of yesterday, up by 0.2% on the Europe Stocks 600. These are some interesting moves in bond markets to get to, and we're seeing selling of bonds broadly across the European space today, but this is government bonds. But we do see, and we see a move higher, therefore, in the 30-year UK gilt yield. And this is in focus because we're getting closer and closer to that cliff edge that's been created by the Bank of England stepping in at the long end to try and calm markets, essentially, after we got that so-called mini budget. What's interesting in the last hour, we've just heard from John Cunliffe at the Bank of England saying that the Bank of England actually identified on the day of the mini budget that there was a risk to the pension system and some of the insurance products that it relies upon. And so that's interesting because perhaps it suggests there was quite low tolerance, low buffers, risk buffers, if you like, for what was going on in markets there. So we'll look for further details on how the market readies itself for normal functioning mid-October. The Italian two-year yield also a little bit higher, but really the questions here are around what the new government is going to do. One of the ratings agencies out with a note on that. And Shell down by 4.2%. This on the back, Kailey, of a trading update from the business. Despite the fact we've seen higher oil prices of late, we've seen OPEC cutting back on production, Shell moving lower on its trading update, which some investors, or some analysts rather, have described as a little bit weak.
All right, Anna, well, that is one equity story we are watching today, but let's talk about equities more broadly now. Joining us is Matt Maley, Chief Market Strategist at Miller Tabak, up early in the morning for us in Massachusetts, which we always appreciate. Matt, it feels like the market is trying to decide if something has changed this week. The Federal Reserve, the speakers we are hearing from, is telling us nothing has changed. We are still staying the course, going to fight the fight on inflation until it is done. We are going to keep rates higher for longer. The market still, though, thinks now that they're going to cut in 2023. How optimistic are you about that possibility and what it means for your view on equities?
Well, I'm not very optimistic on that view. However, what I think a lot of investors are doing right now, especially on the institutional side, we're seeing. The biggest issue is what happened with Credit Suisse, and people are thinking, oh my gosh, maybe something is broken. A lot of people have been saying for a long time that the Fed will keep tightening until something breaks. Well, did something break? I mean, I think a lot of people are worried that that's what happened with Credit Suisse, and therefore the Fed will have no choice but to pivot early next year. I'm not so sure that that's true. But if Credit Suisse is, there's definitely some issues there. But once those seem to be those issues calm down, we still have to worry about a recession. I mean, the market right now is still on the expensive side. And if we go into a recession, what happens in every recession, at least since World War II, is earnings have gone down. If earnings go down in a market that's already slightly expensive, they're going to get even more expensive. The market's going to have to come down further. So whether we see a further rally over the next several weeks, I still think it's going to be a good opportunity to take some chips off the table.
Just so I get a better understanding of what has gone wrong at Credit Suisse, Matt, they have a Tier 1 capital ratio of like 13.8%, very strong, right? So they're not looking to face liquidity issues in the near term, but it's been a lot more expensive to insure against a default in their bonds. Doesn't mean they're going to default. Their equity fell to an all-time low, and it looks like some market participants have pulled back in terms of, giving them equities to give out to short sellers. What specifically is the concern around Credit Suisse?
Well, I think the biggest concern really involves their derivatives book. I mean, we have the bank. At least I don't think anybody's really talking about a repeat of 2008. But if people start, we're worried about counterparty risk, I guess, as people worry about, geez, if they're going to fail or if they're not going to live up to their obligations, suddenly a bunch of hedges out there aren't hedges anymore. When they go to get their hedge, and a bank like Credit Suisse would say, "Sorry, we're failing," that unravels a whole lot of hedges, and that creates a big problem. So that's the concern. Whether that's a real risk or not, we don't know, but that's, I think, really what the markets are betting on right now. That something with Credit Suisse will force the Fed to, even if they don't pivot, at least they'll pause. I don't think that's enough to really keep the market from falling further, but it could buoy it for longer than I had been thinking a week ago.
Well, yesterday we heard Mary Daly tell Michael McKee that she wants to raise and hold, which I thought was a little bit more bullish than raise and raise, right? And in terms of the pivot, the Fed has been very clear they're only going to cut rates once inflation gets back down to close to 2%. Now, what do you think they mean by that? Is 4% close to 2%? Does it have to be 3 or less? Do you think they have a set number in their head? Because inflation, especially after the comps of this year, next year is going to be much weaker.
Well, the biggest concern I have is that even if it's, people say, well, geez, maybe they'll raise it to 4%. That's going to be good. How good is that? I mean, really, again, in a stock market, because if we're at 4%, suddenly those, 17, 18 times earnings valuations that we've been used to for a while no longer are valid. You get the higher those interest rates are, the lower the multiple has to be, and we're not there yet. So again, I think this is a situation where people are getting, they're thinking, oh my gosh, if the Fed is not going to be quite as hawkish, therefore they're going to go back to QE, and that's just not going to be the case. We're not going to be able to have those valuations. So again, if we get a rally in the fourth quarter here, I don't think that's going to bode as well for next year as a lot of people think, because we're heading for a recession. That's just not good.
Matt, I spoke to a guest earlier who told me that in his view, the pivot means stopping hiking. Others seem to think that a sufficient pivot for risk appetite could be stopping hiking so much. And some obviously think that we need to see cuts in interest rates to be a full sort of pivot. How are you thinking about, are we thinking about it in too binary a fashion, what a pivot from the Fed might mean?
Yeah, I'd say, should it be pivot or just a pause enough? I mean, again, that it'll be better for risk assets if the Fed doesn't keep tightening, but it's not going to be better for inflation. And inflation will create a problem. It creates stagflation, et cetera. I mean, it's going to have a negative impact on earnings, I guess, is my point. And so that you do need, again, if you want to go back to what we saw before the Fed started tightening, you need a cut in interest rates and QE to justify those high valuations. And we're just doesn't seem like we're going to get that. My point is that a pause is not enough to help the market rally a lot. And maybe it helps it from selling off as much as people have been worried about, but I think it eventually will cause the market to go lower because, again, without QE, the market was artificially high because of QE and zero interest rate policies. We're not going back to that kind of policy, at least from everything the Fed is telling us.
Matt, thanks very much. Thanks for your input. Matt Maley of Miller Tabak. Coming up on the programme, we'll get further insights on oil, part of our interview with the Russian Deputy Prime Minister Alexander Novak, and also our conversation with the Saudi Energy Minister. All of that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the Estonian Prime Minister. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, OPEC Plus agreed to cut its output by the most in 2 years. The alliance plans to slash daily output by 2 million barrels a day. That move drew a rebuke from the U.S., which has been seeking more oil from producers. Russia's Deputy Prime Minister Alexander Novak spoke exclusively to Bloomberg in Vienna.
Indeed, there have been two important decisions taken today. One, you have already mentioned, and that is the decision on cutting quotas by all countries present and by all countries in the group. But the second decision, which is just as important as the first one, is actually the extension of the Declaration of Cooperation, because it was scheduled to expire at the end of 22, but now it has been agreed that it will be extended until the end of 2023, which gives the market significantly more certainty and significantly more predictability. And that's why a decision was taken to balance the market out by these cuts, by cuts versus quotas of August. And especially this is very important ahead of the winter season, when we would also see the seasonal decline in demand by 2.5 to 3 million barrels. And this decision, which has been made today, helps the market to balance it out. I think it's a very weighted decision and a timely one.
That was Russia's Deputy Prime Minister Alexander Novak emphasizing cooperation between OPEC Plus members. Meanwhile, the Saudi Energy Minister says the United States-led plans for a price cap on Russian exports only add to market uncertainty.
We wanted to give the market a clear direction, a clear input. That's why we extended the agreement to end of 23. But we still have the same tools in our kit, Guidance to the market is crucial, because without guidance, people would not invest, would not feel safe that they could invest. However, we still have the tools in our kit. We still, we reduced the amount of meeting, we reduced the amount of overall expectations of doing something, but we still maintain the same flexibility. We still have every 2 months we will have a GMMC. That GMMC is warranted the authority to have more than a meeting in every 2 months. It also was given the authority to call for a conference meeting if necessity dictates that.
That was the Saudi Energy Minister there. Let's get some expert analysis. Will Kennedy joins us, Bloomberg Senior Executive Editor for Energy and Commodities. Will, the action we saw yesterday by OPEC Plus was met really instantly by some objections from the United States, from the White House. Why should we be so surprised that there was cooperation between OPEC Plus countries and this is what they delivered? It seemed as if the US may be wrong-footed by this, but OPEC Plus as a grouping has existed for a long time, and Russia has been part of that.
Well, there was a lot of diplomatic outreach earlier in the year, just a few months ago, between President Biden and Crown Prince Mohammed bin Salman. As you remember, President Biden traveled to Saudi Arabia and he sought more oil, and his political priority has been really to keep gasoline prices low. He's facing a difficult election in a month's time, and amid that, OPEC comes with a surprisingly large cut. I think if we were talking 10 days ago, no one would have said that they were going to cut quotas by 2 million barrels. They've done that because they see a lot of uncertainty in the market. Prices have been quite weak recently. But from a US perspective, it probably was quite a surprising move.
And is there anything they can do to counteract that, Will, realistically?
Well, the US has been intervening heavily in the oil market by releasing oil from the Strategic Petroleum Reserve. It's released almost half of what's available, so it could do more, but there are dangers there clearly in running down that stock of inventories too hard, so that will be one consideration. And they can look to encourage more oil production elsewhere. It was interesting that there was a report yesterday in the Wall Street Journal that they might ease sanction on Venezuela's oil industry. And of course, the administration has been keen to have a deal with Iran.
Will, don't we have enough oil for us to use here in America, right under our own earth? Why would we, fly to Saudi Arabia courting Mohammed bin Salman and ease sanctions on Venezuela when we could just be nice to the people in like Texas, Oklahoma, and the Dakotas and get our own oil out of the ground?
Well, you don't have enough oil, frankly put, Matt. The US has a lot of oil, and oil production has increased markedly over the last decade, but it still imports huge amounts of oil, especially from Canada. That's not exactly how the oil market. Well, that
different countries.
You better tell Justin Trudeau that, because I think he might be a bit worried. But no. The US does not have self-sufficiency, and it's a global oil market. Could the US try and keep more oil at home? Perhaps, but it doesn't. The oil is fungible, and the Middle East, the OPEC, Saudi Arabia remains absolutely critical to balancing the global oil market. It always has done, and it still does. And Saudi Arabia is really the only repository of spare oil capacity in the world. So whether President Biden likes it or not, Saudi Arabia remains an absolutely fundamental part of the global energy system.
OK, and so we see calls now for oil likely going over $100 a barrel. Thank you very much, Will Kennedy, Bloomberg's Will Kennedy, with the latest on oil markets. And Canadians, fear not. Matt Miller, I'm sure, was joking. And anyway, he's not in charge.
Kidding.
So you have nothing to worry about. Coming up later today, more on the global oil market. We will talk to Stephen Schork, principal of the Schork Group. That's at 7:30 a.m. in New York, 12:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a look at what is ahead on this Thursday. The ECB will be publishing an account of its September policy meeting at 7:30 a.m. New York time. The European political community will be meeting for the first time in Prague. Plus, on the economic data front here in the U.S., we'll be getting initial jobless claims at 8:30 a.m. Eastern ahead of tomorrow's payrolls report. And we'll be hearing from more Fed speakers throughout the day, including Minneapolis Fed President Neel Kashkari, Chicago Fed President Charlie Evans, and Cleveland Fed President Loretta Mester. And Anna, I would imagine we'll hear something similar to what we've already heard from the likes of Mary Daly this week. They're going to keep going. They don't plan to cut in 2023.
Yeah, this Fed is not for pivoting, seems to be one way to summarize it. Now, let's think about how high the Fed goes with its rate hikes, shall we? Because we've heard over and over again about the concept of neutral rate R star, where the Fed needs to hike in order to balance supply and demand to rein in inflation. But Bloomberg's Valerie Teitel has been talking this week about another concept that's doing the rounds. I think a paper from the New York Fed put it out there that might complicate the Fed's inflation fight, and Valerie is here to talk us through it. So, Valerie, we've heard a lot then, R star, the neutral rate, where the Fed sort of weighs down on demand so that demand comes down to match supply, and lo and behold, inflation comes down. But R star is a little bit more complicated. Take us through it.
Yeah, so this paper went over this concept of R star, which is the level at which we reach financial instability. And the one conclusion from this paper is that after a time of low interest rates, when leverage is built up in the economy, similar to what we have today, that R star drops below R star. Meaning, as the Fed hikes rates, we hit a point where we hit financial instability problems before we begin to tackle inflation. And its argument was that the length of period of time where rates are kept low, this excess leverage built up, that this gap actually widens.
All right, so looking at this chart, I see a couple arrows for the past few hiking cycles. Is this one different? Is this cycle going to be different?
So look, there's a few reasons why this cycle is different. One is we have a more obvious urgency to hike rates to dampen inflation. We have an actual inflation problem. The second, if you look at it, maybe R star and R star before were closer. So 2008, the credit crisis, we saw cracks in the credit market. And then you look at the previous hiking cycle in 2015, where we saw cracks appear in the repo market. But maybe that was fine because R star and R star were close. So we didn't necessarily have this gap. Now, today, we have an actual inflation flight. We have an urgency to hike rates. And we could get to a point where the Fed needs to consider financial stability concerns before inflation turns around. And we always talk about this delay of transmission, like the transmission mechanism. You know, it'll be a few months before the rate hikes that the Fed has gone through to hit the real economy. But what if it's not just a delay? What if it's a completely different level where we see instability versus inflation declining?
Valerie, thank you very much. Bloomberg's Valerie Titel joining us with the latest on this really interesting concept. And Kailey, we've been talking about this a little bit this week. Valerie's been talking about this week, sort of behind the scenes and also on set with us, and also flagging how the Bank of England works into this, that this could be an interesting example where you see quantitative easing happening at the margin. They don't use that term. That's not what it's supposed to be. But we've got targeted policy action from the central bank at the same time as you've got interest rates going up.
Yeah, it's a question of what parallels exist there. And I would point out for everybody listening to us on radio, you can see that fantastic chart and the arrows that Valerie was talking about by checking out GTV Go on the Bloomberg terminal. That's where you'll see all of our charts that we use throughout the program.
That is it for Early Edition. More surveillance is ahead. The team will be Tom, John and Lisa, of course. They'll be hearing from a range of voices, including the Estonian Prime Minister, a gathering of European leaders happening in Prague today. This is Bloomberg.